Excellent.
It's a little wonky over here, but I'm certainly not going to put my AirPods in because I look like a big nerd with them in filming, as I noticed from watching last week's show.
Welcome to the Quantum City Initiative, a show about the most important stories, ideas at the intersection of AI, cities, real estate, and the leaders shaping the future of how and where we live and work. Do you save and reinvigorate cities, or are you building new ones?
What is most critical for cities in the future with the sort of AI factory race to work? Okay, episode 16. Welcome to the QCI show. Big week this week. A lot of action, a lot to talk about. The government is open. Big news this week, but Scion and Michael Burry's firm, who's famously short and predicted 42 of the last two recessions, is closed. Chase, how you doing this week?
I'm doing great. I'm excited for the show.
Excited for the show. So that's awesome. Government's back up. Hopefully people's air travel gets a little bit easier. Michael Burry put 80% of his portfolio of his hedge fund short Nvidia and short all of AI. Well, this week the news was he decided to deregister from the SEC.
What was that about?
I don't know.
There's a huge tech sell-off. Futures are down as well.
So the talk apparently is that this is similar to what he did during the Great Financial Crisis, which is where he sort of came to fame and was famously covered in the movie The Big Short. He did something similar. And if you recall, the big thing with The Big Short is that it took 18 months for him to realize his obviously massive gains in his position. So the talk here is that this is just all part of his plan. And this is a way that he is sort of reducing the heat. Now, if he does return his capital, that's an interesting element. But it looks like no matter, even if he returns it or not, he'll still have a 10 million short position, which could return something up to about 500 million if Nvidia and some of the AI stocks do hit a certain threshold sell-off. So a lot to watch there.
Oh, fun times.
Fun times. All right. This week, what are we talking about? Let's talk about the office market. We'll certainly talk about some financial news. There's a lot of news this week. Let's talk about the office market. And then let's talk about the work from home market and sort of the balance between the two. And then we got some fun, obviously one more bit of news. And we'll talk about Austin, Texas. Austin has been in the news. Texas has been in the news. A lot of companies, I think Coinbase was the most recent one this week that actually is getting away from, they're going to file in Texas instead of Delaware. So Texas is hot right now. Anyways, anchor story this week, the great office recovery, why the flight to quality is really the flight to survival. So we've talked about some of these numbers. Chase, I know you did a deep dive. I know you got a lot to talk about. I'll set the stage a little bit for you. U.S. office leasing activity totaled 203 million square feet in the first three quarters of 2025. That is still, despite the positivity that we breed on this show every single week, that's still about 15% below pre-COVID averages. However, if you go into the details, there are some hot markets that are there. San Francisco's leasing activity is up 47% year over year. Manhattan has risen 9%. Both are approaching actual pre-COVID levels. So they are sort of bringing the average up, right? There's a handful of others that are bringing the average down. Where you see the big bifurcation is in the asset classes themselves. The trophy office leasing market is 12% higher, almost 13% higher than pre-COVID. Class A properties remain 20% below pre-COVID. B and C are down more than 30% pre-COVID. We have a trophy that sits above A. So is A really B? A hasn't kept up. The way I look at this, A hasn't kept up, and B and C, well, they're in trouble. What's driving the recovery, man? What's your take?
Well, I believe global office leasing just hit a 6-year high since 2019. So that's good news. It's just so funny how history repeats itself, right? Death of retail, and it was the bifurcation of retail. Death of office, it's the bifurcation of office. Hybrid, really wasn't kind of the obituary or death sentence that I think was covered in the news, but it is a sorting mechanism, if you will, in terms of this whole haves and have-nots. Now, I put together a little chart that I'll pull up for our friends in the audience here. So let me just quickly share this. So I went back through, I got to give a shout out to our friends at Cushman and Wakefield, MSCI, and obviously the Fred for this data. But I went and pulled leasing from 2018 through 2025 year to date, leasing net absorption, vacancy rate, and office using employment, which Cushman does a great job of pulling. So what you can see here is that top line leasing has kind of gone through these fits and starts, right? And I think global leasing is another category. I just focused on the US because
Mhm.
Cushman, what you see is like this tapering off from over 300 million that just kind of hovered. And obviously, leasing, if you jump down here to the Fed funds rate, people spend when money is cheap, but it dipped below 323 and 24. And so far in 2025, comeback's pretty good. Q4 tends to be the biggest leasing quarter. So we got a shot, I think, at sniffing that 300 number again, which is where all the headlines are coming from. I think most importantly, and this ties into this flight to quality, because I actually think there's going to be a little bit of not necessarily a reversal, but I'll get into this. You look at net absorption, which is total leasing activity, obviously minus churn,
Mhm.
and we were positive pre-COVID, and we've just been getting crushed from 2020 still through 2025. Net absorption is negative, and that directly correlates to our sky high vacancy rates here in 24 and
And so
25.
net absorption, again, real quick, net absorption is folks getting out of leases. It's the difference between newly leased space and effectively folks vacating leases, right?
Yeah, how many people moving in
Yeah.
minus how many people moving out from a square footage perspective.
So
You
the
can
pie's getting a lot smaller.
Yes. And so vacancies up, which is, office use and employment in the US has mostly kind of fluctuated between 32 and 35 million people. So I don't think the mass layoffs, now, if you were to pull this apart, I think a third of all the leasing activity this year is in fire, right? Finance,
Mhm.
insurance, real estate. So professional services are coming back, big markets where top tier firms, I think, are leading the way with New York and San Francisco. And then what you see is the supply side, not surprisingly, tends to follow demand. So as net absorption has gone up, as vacancy has gone up, the construction pipeline has fallen off a cliff, and new office deliveries has fallen off a cliff. This is also tied to when you think about the cost of capital and then the risk-free rate of the 10-year treasury. If I can get 4.2, 4.3 with US treasuries, I don't know how risk-free it is with our debt, but this explains the lack of investment. And my guess is if we do get, if this Fed funds rate, even though the Fed in their most recent vote seems pretty split on cuts before end of year without the government data. But I would have to imagine that if this rate comes down, you'll start to see some supply increase. But if supply doesn't increase and demand stays trending up, some of those older Class A, maybe Class B, are the only show in town, since there really isn't a ton of new supply coming into the market, right?
Was that a good thing? So my take is that the investment dollars will drive the demand, right? So the supply kind of needs to drive the demand. Now, what you're saying here is that the demand is there, or there's the green shoots of it and it's doing its thing. Maybe the flight to quality, there's no trophy assets available, really, right? Like we know that those are sky high, over $100 in Boston, over $300 in Manhattan. So the quotes that or the numbers I was just saying, where sort of sub A or tired class A and B and C, they might be in trouble. You're saying this might be the resurgence where they're now going to be the only spaces left to rent.
Well, I think what we're going to find out in 2026 is, are these trophy assets really driving demand, or is the demand coming back because in-person work is valued and the more obsolete down market assets will prove to be valuable? I don't I don't have a strong opinion on it. I would probably have a stronger opinion once I see Q4 numbers come in for 2025, but we're going to we're going to see. We're going to find out because when you look at this pipeline, the fact that there's record low office construction pipeline means if trophy in the top of the market really is fully leased out, if demand continues, then it's going to open up a lot of opportunity for people to kind of start to slot in underneath trophy, which we've talked about on this show. You look at the average US rental rate over the last 7 years, it's somewhere between like 36, $37 and upwards of 41 now. So, how many people can really afford Manhattan like rents in the 60s, 70s on average? And really the trophy assets are 100 plus, right? So, the price premiums that the trophy get, I think, is incredibly prohibitive for a majority of demand. And there might be demand for, lesser capital required to just update some of the more obsolete product. But overall, I think we probably haven't bounced until that net absorption rate for the calendar year goes positive. I don't think you can say we've bounced off the floor, but it certainly looks to be trending that way.
So, there's an interesting discussion going on. We talk to a lot of customers who are going through an asset sale and sort of the idea of, or they're trying to put together the ROI calculator on what kind of CapEx improvements they want to do for an asset, depending on the hold period, right? I like what you're getting at here is this actually could jolt a little bit more of the asset sales because you're going to have less CapEx coming in and you're going to have a quicker ROI rate. So there's a lot of developers out there that don't want to be in the long hold market right now. They're looking at 3 to 5 year spans and they can actually put less, quote unquote, lipstick on the pig, less of a CapEx investment, and yet still see some of the leasing rebound. I think that's an important thing to watch in 26.
I think there's a viable strategy there. Not everyone can afford the rental rates of trophy. And particularly as investors look for places to put capital, I think there's a lot of competition and risk in data center.
Yep.
I think there's a really interesting opportunity to go in the kind of non-gateway markets where the rental rates are sky high and there's a whole segment of the office economy when you look at those labor numbers, north of 30 million people are office using workers. I think there's a lot of people that could be in that A minus premium B plus that there's an interesting product type.
And there was a lot of money made, specifically in Boston, but in a lot of markets on the old brick and beam. Class B had its time. And
Yeah,
I
that
think
was
you
super cool in like 2012 to 2015.
right. And I think you kicked off the show saying it's just funny how things are cyclical. So what's old might be new again. Love that, especially on the return side and on the asset sale side. It's something to watch there. Okay. So this is a nice tie into the flight to quality and the Rex U section we're going to talk about today. We're going to talk about bridging the home office with the actual office and sort of why go in and commute. We acquired a company a couple of years ago called Leaseman. Leaseman has an incredible data set, which is why we chose to partner with them. They work with all the sort of Fortune 1000. We're actually working on a little project with JP Morgan. You might have heard about their new building where they utilized our team over at Leaseman. They are in with some of the top sort of office occupiers that are out there. Well, rattle off some data and I want to get your understanding with sort of what you just talked about and then really what's driving some of that recovery there. So Leaseman's post-pandemic data. So let's talk about, I guess, Q1 22 to Q1 25 covers about 600,000 offices and about 400,000 home working responses. And what that data was telling us is that the average home outperforms the office settings in supporting some of the key activities that people need, right, in order to be effective. 93% of the respondents say their home environment enables them to work productively, compared to 69% who agree their workplace affords them the same productivity. Before I go on, I'd love for you to comment on that, Chase.
Yeah. So what I like about, and obviously why we made the decision to acquire Leaseman, is that it's an important set of data to see how employees feel they perform at home versus the office. But what Leaseman does differently than some other, let's say, HR type surveys is it's more about what do you need to be productive at the office place. And I think
Right.
it's a critical differentiation compared to what are your feelings and what do you like? Because I think the media continues to jump on the type of feedback that you see it in, like Microsoft did it, you see it with a bunch of the big HR surveys, where if we traded stocks and invested capital purely on how people felt about a business rather than underlying financials, that would be a difficult place for us to be. And the reality that I think we've now been talking about for years is that no one should be writing posts about whether it's the how the bosses feel people perform in different locations or how the employees feel they perform in different locations. We need to actually start to get some data that suggests like some key indicators of, I don't know, pick your KPI for different roles and let's start to comp how much of a, key performance indicator moves depending on where they work, right? Because everybody keeps talking about feelings. It's not that useful. Now, where the Leaseman data is useful is around what they need to be productive. And I think that's why it's so valuable. So, what we see time and time again is, from the Leaseman data that we get, that the ROI of workplace and real estate experience, it's not sentiment. It's always about removing friction, because
Right.
there are two reasons employees don't want to be in the workspace. Number one is the friction of getting there, which I would say is overwhelmingly the commute. And then number two is the sense of freedom. Like, most people don't like being told where to be and what to do. Like, even if that's the
Those
majority of
RTO mandates. Yeah.
So I think it's a super important barometer, because if you can get a sense of, as a landlord or as an employer, if you can get a sense of when they're here, are we doing the best job that we can? You can't really change the commute, right? I
And
think that.
that, to me, that's the most important thing as we go through this data and we talk about it, is what this information has done. We're not sitting here saying that like everybody's got to work from home and work from home is so much better or flexibility is so much better. There is a time and a place for that. I do fundamentally believe. I don't
Sure.
think we all work from home, and I don't think, as you have articulated in the past, how Ford sort of came up with the original 9 to 5 working the factory lines. But like, even if you look at the data itself, 70% of employees feel that their office supports visitors, obviously. Social interactions, hugely important, 84% resonated with being in the office. Learning from others, 86%, massively important. Group meetings, collaborative work, creative work, all rank higher than the home. What was interesting about the home's data was it was really around comfort. It was really around quiet space. It was really around autonomy, sort of
Yeah.
this notion of like focus and recharge spaces. And the way I look at that, and sort of what JP Morgan has done and how a lot of the customers have utilized this data, is they're taking this and they're not saying like, oh, well, my employees can pound sand if they want to go work from home, even though I do believe that's Jamie Dimon's
With that.
on it. But what they're doing is they're taking that data and they're trying to find about what is that mix? Well, what does work at home? And what are those things that you can improve comfort? So you can go over the commute. And I think that's what you're seeing in the trophy assets. When we tour the Penn 1s and the Penn 2s, and we'll talk about some leasing in Penn 2 later, when we tour South Station Tower, it's a different look and feel than the new offices that came online even just 5 years ago. And I think that's the important piece from all this data, is that the office market is listening to this, right?
Yeah, and I think you said one word that I think simplifies the whole situation down, which is autonomy, right? Like, the reason, yes, there's a time element of the commute, and everyone's most valuable asset is time. But I think the big underlying thing that people don't talk about with regards to return to office is autonomy. When you work at home, you personalize everything, to the setup that you like. So this is why I think smart building technology is going to have its moment, because It's very hard to have one big bulk product and make personalization happen. And the way that you do that is through technology. So if you can increase the levels of autonomy, then you're gonna start to meet the needs of downstream, whether you want to call it comfort, or there are certain things that I look at it as an equation, which is if you were to take the annual salary of, or, wages, whatever, of a person that makes that commute, what is the value of an hour of their time? Um, what is their commute cost, if you will? So if you make $10 an hour, to keep the numbers simple, and your overall commute is 2 hours, how do we make up $20 worth of time value by bringing them in? And there's services and experiences and social interaction that's how I would think about programming a building, which is, can you collect the average commute time, get a rough sense of the value of that person's
Yep.
time, and provide more value? And our buddy Joe Pine in the experience economy says it's not just time saved, it's time well spent. And I think we can get pretty scientific and formulaic about, like, does an asset create valuable time that, it puts you in the black versus the red on the commute time?
I think that, what's shocking to me, and super biased, obviously, with that work at HQO, is that this data still isn't readily available at every office. I fundamentally believe it's hard to navigate this environment. So you kind of kicked off the show. We talked about some of the data around the office recovery. Then you talked a little bit about how sort of the class A minus, sort of B and C might be having a moment, right? That sort of brick and beam space. To me, if you're thinking about putting CapEx dollars into a project, you should, like, with an absolute surgical level detail, know exactly where those dollars should go, and not just say, ooh, golf pod, or ooh, new marble in the lobby. You should know exactly what it is in order to generate the highest ROI in cap rates, and ultimately, whatever is the asset sale or however long your hold period is. It's insane that this data is not more widely adopted. Whether it's HQO's Leaseman data set or not, it just feels like we're still flying a little bit blind here.
Well, and I think it's two-sided, right? I think on the one hand, the tools need to evolve, which obviously we work on,
Yep.
such that it's very easy to measure these things. So there needs to be some improvement there, but there does need to be a wholesale evolution of how, if you're in the business of workspace, like, you need an ROI calculation for every single individual in order to earn, the top line rent revenue, or the flex revenue, or whatever product and packaging you go with. At the end of the day, they pay money over a time increment for space. And how do you measure the ROI, right? So this is one of the things that we talk about all the time when landlords ask us what's the ROI of the technology. And I'm happy to get to that, but what's the ROI of the office, right? Like, how do you measure your ROI for your tenant companies? And in several years, I'm yet to get someone who can explain that in numbers. And I understand why it's challenging, right? You have to get data first before you can start to, make a calculation on that for ROI. But there does need to be, between the will and the skill, we need some will before we develop the skill.
Love it. So we're going to, and again, one of the things that we're trying to do is obviously incorporate some more of the data that we have. So I thought this was a great deep dive. We'll keep messing with this one. If you got feedback, please continue to ping us as we sort of dive in on future shows on the Leaseman data set and the immense amount of data we have on the occupiers and how it's shaping the commercial real estate office. Okay, let's move to Quantum Review. This week, Austin, Texas, everything, what's it saying? Everything is bigger in Texas, or is everything's better in Texas? Or is it both?
Everything's bigger in Texas, but we should look into that.
Everything might be bigger and better in Texas. Okay, so let's talk about Austin, Texas for a little bit. So this is the QCI show. We've talked about a couple of major metropolitan areas. We've talked about a handful of cities. Austin has been the fastest growing large metro area in the country for over a decade. It is now second place nationally, growing at almost 2%, or just above 2%, almost 3%, adding more than 50,000 residents between 23 and 24. the city's tech ecosystem really is driving that. I also think there's a little bit of the what do we like to call it? The political red tape sort of loosening. A lot of conversations around New York City, folks leaving, obviously companies leaving the Valley, NSF, companies leaving New York City. We saw a lot of the hedge funds during COVID move to Miami. Obviously, we saw Elon Musk put his money where his mouth is and move to Texas. Again, we're seeing companies like Coinbase incorporate in Texas, which lends me to believe that they might be on their way to physically moving there. It's a little bit different sort of what drives them. And from a commercial real estate perspective, what is it that makes Austin? What is it that makes Austin so appealing from a QCI or from a quantum city perspective? Well, what's drawing Mr. Musk and a handful of these companies and residents there? We know Jason Calacanis famously moved there, if you're at all in pod. And I just saw a deep dive in TikTok, big talker now, on Adrian Grenier, the Entourage guy.
Yeah, he's been in Texas for a while.
I didn't know that. But now he's got some insane ranks. He kind of beat everybody. He did it before it was cool, which is no surprise. Vinny Chase was the man.
Catch up.
What is it with Austin that is so appealing, from a quantum city perspective?
Well, I mean, first and foremost, before you get to Austin, what Texas has done is, for the most part, I think they nail, from a business perspective, what we talked about in the last segment of return to office. They nail freedom. That's autonomy for people, and businesses have a lot of autonomy. You're seeing a bunch of businesses reincorporate from Delaware, where there's some judges getting involved in business matters, to Texas, Nevada, whatever. But I think what Austin is nailing, outside of the fact that it has kind of the combination of the gateway city tech kind of, liberal, whatever culture, but they're scaling both population and infrastructure really without face planting. They do have a lot of space down there. Obviously, that helps. They're kind of nailing the let people build, which I think, this is why we wrote the original Quantum City Initiative paper, is because I think we do need a national initiative on our city development. And I think there's a lot to learn from Austin. Some quick stats for everyone. Austin is apparently still adding 50,000 people per year. So it's growing well. Obviously, they have some big anchor companies with Tesla and the ones that you named. They've got a lot of talent. They have very defined compute strategy. There's plans for how they have a modern city. So it's, they're going to face what everybody faces, in the sense that they apparently need 150,000 megawatts to continue to power things. They've got a lot of data center work going on.
I think that's the challenge. Austin, obviously, and like you were saying, and you're going to go into data center numbers, but can the power grid support? And what you're seeing, though, is that Austin is ahead of it, but can they keep up that investment into power? Because power, there was another article that I didn't pull in to this week's show because we had too much to talk about, that basically was saying the future of cities will be around the power grid. Where the power is most efficient is where the density will go and the talent will go.
Yeah, and I think what Austin so far has done is that it's kept its culture while accelerating its economy, right? You go to Austin, everybody wears the I think it's West Austin, I don't know. Keep Austin weird shirts. So
I've never been to Austin.
Oh, it's fine. I'm an ocean guy. I love Texas, but I'm an ocean guy. They're going to have to figure out data center stress, but they've done a pretty good job of keeping the culture, where I think you see some of these other southern cities and the people that are attracted to them. There's a pretty big culture clash from the typical Northeasterners that move down there, whereas Austin has a little bit of a California live and let live. I think it integrates a little bit better, and they're getting the kind of live and let live, but also let's build business types. And that's kind of the perfect mix.
Yeah, I think it's going to be I mean, listen, it's nothing new. Obviously, Adrian Grenier was ahead of everybody, and I need to keep up. Austin seems to be the place to go. I do think there's going to be an interesting tie with this notion of companies incorporating in Texas. Companies incorporate in Delaware for a number of reasons, and one of them is not to move to offices to Delaware. So there might be something with incorporating in Texas, and then actually with the progressive work, the investment, the sort of lack of red tape, the accelerated permit process, the autonomy, the freedom, it might start to drive a lot more companies to Texas. Like you said, they have a lot of space. Obviously, it's vast. Everything's bigger in Texas. But local government is putting its money where its mouth is and investing in the infrastructure needed to be able to support adding 50,000 people a year continuously and all those companies and corporations. There's a lot of investment there.
Yeah, it is.
All right. Next week, new city. Back to the news. Quick hits. Okay. Let's keep going on. Momentum. Momentum is key for a lot of different things. One, for my mental health, we need to keep momentum going, specifically in commercial real estate. Momentum is important. Let's keep it going. Commercial real estate lending is back in motion. So lending momentum hit its 7-year high. So why is lending momentum important? What this is signaling is that transactions are happening, assets are being bought and sold, and debt is being refinanced. While interest rates are still high, they're coming down. There's activity in the market. Lending is back.
Yeah, I mean, we need investment. I think to keep that momentum. And look, if we're just playing analyst, I'm interested to see what happens with demand if the capital markets stay dry. But we're not. We're active players in the market, so I do think with lending and with repositionings and capital improvements and all that stuff, I think it will continue to help stoke demand. So hopefully we can kind of thread the needle here at the end of the year. I'm a little worried about the labor numbers. Apparently, they're not going to release the labor numbers at the end of the year, even though the government is back open. And there's too much gamesmanship on both sides with the labor numbers. They come out and then
they get revised down.
Yeah, they get revised down, and now we're not releasing them. Like, it's total BS. And frankly, it's just insanely antiquated how we collect the labor numbers, like calling people whatever. They should go to Workday and all the major HR systems and figure out a better way to get accurate and fast data for us to make our very important decisions on. But I do think, administration they announced they're bringing down tariffs on like coffee and fruit. So hopefully that'll help with inflation. Obviously, there's already a soft labor market. So Fed will have mandate to cut, which, the Fed funds rate being over 4, would love to see that come down. So let's keep this momentum going, baby.
Let's keep it going. The data we are quoting here is CBRE's Lending Momentum Index, which jumped to 1.04 in Q3, which is 112% year-over-year surge, which is the strongest lending pace since 2018. I don't know if I kicked off the segment with that data, but that's the data that we're suggesting. Again, the important thing is when lenders traditionally get involved, liquidity comes back. We've talked about secondaries in the real estate market. This is good. Money is trading. Liquidity is coming in. Love it. Speaking of liquidity, there was a weird article, and we're not going to talk about it, but we are talking about it. Robinhood partnered with GoPuff you could take money out of your Robinhood account, and GoPuff would deliver a bag of cash in like a day. I think it's a delivery service. So I could sell one Nvidia share.
We could have taken that a lot of different ways.
And I got a bag of cash delivered to me. Anyways, okay, let's keep going. So this is actually an interesting tie to lending and REITs, obviously. The Artist REIT, which is a 9 million square foot Canadian landlord, has been sort of stable for a long time. It's got some great quality assets. They're actually merging with a bank. And so a bank is acquiring a REIT, more or less, right? So let me set the stage a little bit more before I get your response. So, we've talked to a handful of landlords over the years where the keys have gone back to the bank, right? The bank has come in and said, listen, you can't pay your bills, can't pay your mortgage. We're going to take the keys. Well, the bank then obviously finds himself between a rock and a hard place because they're not sort of sophisticated with the ability to property manage and sort of asset manage an actual asset, right? So that was kind of the issue where banks were threatening to take them back. Then they would do the extend and pretend because they didn't really want to take them back because the banks didn't want to manage it. Well, now you have a REIT merging with a bank, basically saying the bank sees a lot of significant, or my understanding is the bank sees a lot of significant gains in all of the lending and refi with the actual REIT. And there's a lot of opportunity there. What's your take?
I think in general, the commercial real estate industry is too fragmented.
Okay.
I think more things need to be together.
Big dollars
About the bank owning the REIT, but when you think about how you finance these things, I'm sure there's some advantages to having those two things closer together. But in particular, when you think about kind of the typical developer business model, and then when you think about the REITs and their hold period, I think if you can bring continual development to a portfolio where you're in the game longer of being the owner and operator of the asset, I think owner operator needs to get closer. I think developer needs to be a core competency of the people who own it, because I think if you build it, they will come. You see this with a lot of REITs. They do a lot of development, and I think they're structurally just positioned to have a much more significant advantage of being customer oriented. So this is attacking that from probably a different angle, which I hadn't thought about, but I think there needs to be much more verticalization.
Well, I mean, listen, we know the big dogs have been expanding their private credit and credit businesses like Blackstone and Brookfield. So nothing new, but interesting to take note of. In the news this week, our good buddies at Vornado have been busy. Signed 2 big leases, pretty big leases. The biggest leases in October, big leases. 225,000 foot deals at Penn 2, the Penn District. So that's Robinhood, who, like we were talking about, deliver cash to your doorstep via GoPuff. And Dick's Sporting Goods, just
amenity. Love that.
Signed 125K square foot deals at Penn 2, which is awesome. We're certainly biased. We love our friends at Vornado. But Josh Flick, good for you, man.
Penn 2 is unbelievable. That entryway that's like right in front of MSG, the amenity space called the Perch, which is the outdoor roof deck, and this is a perfect example, right? They're developers, but they are structured, and REITs have this advantage because they can kind of move people throughout the Penn District buildings, so you can share amenities across it. It's obviously it's a relatively unique campus in that it's on the one of the world's most populated transportation system stops. They orient themselves around the customer, unlike a lot of other groups, and they are starting to flex kind of the campus value rather than urban campus compared to the 4 walls of the lease that you took. So not surprising, and we love being in Penn 1. We got a lease there. They did a great job with that building.
Good job. Okay, let's talk. So if you're looking for new space, in the Penn 1s and the Penn 2s, one of the things you're going to negotiate is TI. If you follow that data, is telling an interesting trend. And I'm interested to hear your take based on some of the data that you talked about sort of kicking off the show. But let's set the table with some of the data here on the tenant improvement allowances. So TI has surged roughly, it's over 100% since 2016. Not surprising. You could claim inflation there. You could claim a lot of things, roughly 60 to 70 square foot, so 60, 70 bucks a square foot. 10 years ago to call it 180 bucks nationally in top markets. And I can tell you in Boston right now, it's about 225 bucks a foot. I have that on good authority from a company looking to move space. But you're looking at about 200 bucks. So TI is growing, which is, we talk about that massive sort of CapEx investment, the sort of cost to acquire a customer for a landlord to acquire a tenant. What's your take on this level of growth? To me, this means the market is still very heavily in favor of the occupiers, right? Which we know. So the demand totally isn't there. But if you are getting still maybe 225 to 300 bucks a foot for the trophy assets, That's got to be pushing people to them a heck of a lot more than the class A and B spaces, which maybe you get $80. So that's their sort of financial instrument to drive demand, maybe artificial demand. I don't know.
Well, it's certainly a bet on the future, right? You're willing to invest up front to win the business. And I think it's also a pretty, I mean, it is the strongest indicator of the product quality hasn't caught up to tenant demand, right? So the fact you have to put that much in up front, make the space what the tenant requires, I think is indicative of the state of supply, if you will. And to your point, it's the state of the imbalance between supply and demand having a ton of leverage, particularly for those groups that are paying up premium rental rates. I'd be interested to see a breakdown of this by rental tier. I can't imagine the TI's down market will be quite as strong, but I think there's a natural progression here, which is you get that much investment up front, they're building something that's truly differentiated for them. I think, and we see this with a number of our customers, it's super early in the game, but I think they're going to start to get smarter about what other uh, benefits can they give to customers up front that aren't necessarily hard to cost. So what types of services and things can you bring in that they're paying for and hit their expenses on the P&L that are oriented around the office, whether it's food and bev and stuff like that, that might not be as costly and irreversible as moving bricks and sticks.
I love TI. I love a good TI budget. Give me it. Let's go to work here. Okay, this headline caught my eye this week, not because I'm surprised at all, and I'll read it out in a second. I'll get your reaction to it, and there's some interesting data. But I didn't think Barry Sternlicht was going to be leading the way here in his understanding of artificial intelligence and sort of what that means for the job market. Okay, so the headline here, or sort of the news here, real estate billionaire Barry Sternlicht. He's by the way, he's does phenomenal on stage. There's a lot of press. He's the founder of Starwood.
Smart guy.
He made headlines this week after saying he plans to eliminate a significant portion of his workforce and replace that with AI. So he just went ahead and said it. I guess what really caught my eye was we've seen these headlines in more traditional tech companies. And we saw Amazon's recent layoffs where they laid off like 35,000 employees. And it was kind of under the guise of the AI making people more efficient and sort of AI taking over. But I guess I haven't seen this really in the commercial real estate world. What's your take?
Well, obviously, Starwood is one big machine. And frankly, for somebody like Sternlicht or any of these kind of celebrity CEO types, I think this kind of headline is a little bit of a win-win, no matter which way it goes. Investors right now cheer with their money when you claim you're going to cut jobs. So, like, you get that at the very least. Secondarily, if he actually thinks they're going to do this, then obviously there's OPEX savings. And then finally, even if he doesn't think it will take that many roles, it's probably a little bit of a fire underneath people to get rolling. And I think you put in here, like, he wasn't vague about the roles, right? He said analysts, asset management support, leasing and tenant relation coordinators, back office functions, market research roles, and investor relations.
There's quite a few. He names quite a bit of the
issue. Like, a lot of these things are where LLMs are very good, right? And so if you can get 80 to 90% of the work product, but we talked about this several shows ago, if you can get 80 to 90% of the quality of the work product in 10% of the time it takes someone, then what you're going to need is just the best of that job role checking the work of the LLM to get the last 10 to 20% of quality, but like it saves them an immense amount of time, right?
Yeah, I guess what I did love about this, like you just said, is he didn't mince words. He just went ahead and said, "These are the positions that I see." Whereas most companies are like, "It's everywhere." He's like, "You know what? Nope. It's analysts, it's asset management, it's leasing and tenant relations." Very interesting.
Yeah.
We're going to be following him. Okay, one more bit of news this week. The favorite obviously sectioned from everybody. What a great show, by the way. 48 minutes in, covered a ton, a lot of news. One more bit of news this week. And you know what? It's a tragedy, man. The United States Mint pressed its last penny on Wednesday. The penny had a just tremendous run, a 238-year run. I mean, what an epic run. What's most surprising, I think I have a penny here, is the cost of the penny. I got a few here. The cost of the penny, right?
Costs more than a penny.
This is bananas. Okay. And why I'm not doing this right now, I can't do it anymore as they stopped making it. But so here's a penny, here's another penny. The idea here, or what apparently the ROI, it actually costs 3 cents to make. Okay. So the penny here, which is worth 1 cent when I go and buy, I don't know, anything, some milk, or actually I don't like buy milk, you buy milk. So if I buy something, it's worth 1 cent. The government takes 3 cents to make it. Why I didn't think of this before, go to my bank, go get a cent, go back to the government and say, I'm going to give this to you for 2 cents. It takes you 3 cents to make this, but I'm going to give it to you for 2 cents. But I got it for 1 cent. I just doubled my investment here.
Yeah, I mean, this is like this was the whole point of Doge. And I'm someone that believes deeply in cost controls, but I'm not sure there's a better example of government work than the CAC LTV math, if you will, or the COGS versus value here is completely flipped upside down. It's 3-to-1 CAC to 1 LTV. So
I didn't go to my bank, bring this shiny little penny.
And I bet you if you were to do an audit just like that, what is the service that is provided? How much does it cost? And what's the value we get in the marketplace? I bet you would see that all over the government.
Yeah.
So I do love, first off, this is like we talked about the Pokemon cards. Value of a penny is going to go up for people that like trading.
I got a
Lincoln.
Got a 2025 vintage right here. Ooh, I have two 2025 vintages. Ooh, special.
Yeah.
Gotta hold on to these back.
So you're a big, is it antiques or collectibles? What are you into?
Yeah, I'm into all that stuff. I wish I was into more collectibles. I'm into, and I guess antiques that are useless, or sorry, worthless. I haven't found the antique market that I make money on. I like to go antiquing, big fan of that, but I haven't made any money on it. But hey, my 2 pennies over here, at least I know that I got them for 2 cents and they're worth 6 cents. So
see, you didn't get them for 2 cents because you're getting, go look at your tax bill.
Fine. Figured I was paying that anyways. What's interesting, before we move on to the second and third bit of news this week, is the $5 bill actually costs 5.3 cents to produce. So there's an ROI there, which makes sense because it's paper with some green ink. Love that. Okay. Second bit of news this week. And honestly, we could have done a whole segment on it, but I brought it here because the memes are just incredible. The Trump administration, Mr. Trump, he said a lot of stuff this week, but one of the things that we want to cover is he proposed a 50-year mortgage. When I first saw that, I'm like, this is beautiful. My rate goes down, or sorry, my monthly clip goes down. Let me be careful with my words here. My monthly clip goes down. And then I started to see the memes. Well, and I'll tie it back to 7-minute abs, 6-minute abs. What movie is that? Something About Mary? Well, we got 7-year fixed. We got 15-year mortgages. We got 10-year mortgages. We got 20-year mortgages. And the 30-year was the longest mortgage that we could have on the residential side. Well, now we're going to choose 50 years. And then all the memes are, what about 100 years? And you know what? At some point, let's just call it rent. And you never actually own the asset.
Yeah. I'm with him on the 50-year mortgage plan.
Okay.
Everybody made fun of him in his first administration for talking about the 100-year treasury. And if we had refi,
he nailed that.
Yeah, nailed it. And look at where we would be today if we hadn't made fun of that. So, but this is, what do we talk about? What's the most powerful thing on planet Earth? Attack of the memes. They gotta get their, army of memers making positive memes about the 50-year mortgage, because I think it would help a lot of people.
I will say,
I do think in Something About Mary, he's like, nah, like 8 or 6 minutes abs, you can't even get a workout in six. So 50 feels right to me. Feels right. You
I
buy
will
your app at 25, have it till you're 75. Fine.
if it does unclog, the important balance here is the rates.
Mhm.
Obviously, to me, this is pressure, his continued pressure to lower rates, right? You can't have a 50-year, well, you can, but it makes no financial sense to have a 50-year note at 6 to 7% when you can do a 30-year note at 6%. Now, affordability aside, you should be maybe buying that house in general. But if this does unclog the residential real estate market, we know that's in a whole ball of yarn right now. If this does get more demand to the table, more supply to the table, I think it is a great thing. But I think it all comes down to the rates. And again, I think this is his ploy to continue to apply pressure to lower rates.
Yep.
Last bit of news this week, and I might squeak in one more, but the last bit of news this week, and this is just outrageous. I hope everybody saw this. You probably didn't because it's such garbage. And I'm sorry, I love Apple. I actually did just get the new iPhone. It's completely the same as every other iPhone that I've owned. But Apple came out, they partnered with a designer. I'm going to botch this. Issey Miak, I don't know, and launched to great fanfare a $250 iPhone Pocket. Now, the iPhone Pocket, before we flash the picture of this sock, the iPhone Pocket explores the concept of the joy of wearing an iPhone. The quotes are just outrageous. They share the design approach that celebrates craftsmanship, simplicity, and delight. I mean, they do. Now let's put the photo up of this sock. It's a sock, man. Am I missing something here?
So a couple of things. First and foremost,
shame on me for not launching it first and charging $250. Fine.
All I could think about was that scene from Zoolander where the Will Ferrell's character shows the model of the school. He's like, "What is this, school for ants?" Like, what is this, an iPhone for ants? You've officially lost your innovation engine when every announcement is like, "Oh, it's bigger. Oh, it's smaller. It's bigger. It's smaller. It's bigger, smaller, bigger, smaller." But I do think with the sock in particular, what they're trying to do and I don't think they're doing it well, but I think what they're trying to do is front run what they're anticipating that OpenAI and former Apple designer of fame, Johnny Ive, they're creating some wearable tech that, is like a medallion or whatever it is. And so they basically were like, well, we're not going to actually do something cool. So let's get a sock that you can hang this tiny iPhone in. But shout out Brett Klebanoff. He's going to love our buddy from home. Still has like the tiniest little iPhone from years ago. He's got a little hand, so he can't reach the buttons, but he now will be able to get the Pocket. He'll be psyched.
I guess I didn't think about your wearable thing, but the quotes, its recognizable silhouette offers a beautiful way to carry your iPhone. Like, get your head out of your whatever. And I can't swear anymore because we don't want to get shadow banned, but like, ridiculous. However, the best wearable on the planet is how I kicked off the show when I looked like an absolute clown wearing these things, because you do still look weird. It's this little device that's in your ear that is constantly listening and taking in and interpreting. To me, this is the best device on the planet, or the best device, not a sock. Carry my iPhone.
Definitely going to get you one of those socks. Please. Although the sock's probably like egregiously expensive. Just
$250. It's $250 sock. It's $250. If you get it for me for Christmas, forever be in debt to you. We'll do this. So we'll do this last bit of news. We're just going to take 10 seconds because Justin has put it in the last 3 weeks in a row, and I've shelved it. Apparently, Kim Kardashian had some racy photos with a Tesla robot or something. So I don't know if that's a real thing in the news, but apparently there's now all these memes and jokes about Kim K with the sex tape with the Tesla robot. I don't know, man. Maybe this is what we need to end 2025 strong. Kim Kardashian and a Tesla robot. I don't know. The relationship that we never thought was going to happen. It's here.
Art always predicts life. They did this in Westworld, and here we are.
What a show this week. EP 16 kicked off talking about the government, talking about Michael Burry and Scion Capital. Spent a significant amount of time on a wonderful slide you put together on the great office recovery. Appreciated that data. Dove into bridging the home office gap. Talk about Austin, Texas, as a quantum city. Went through a ton of news this week, only the best news that we talked about. Obviously, Penn 2 with some great leasing numbers, a REIT being acquired by a bank, the CRE lending momentum. Thanks for coming out.